We are back with a new video on financial planning and what are the lessons to be learned from this COVID 19 crisis which is going on. This is nothing but the coronavirus pandemic which is going on, and what lessons it has taught us in our personal finances. So, this was a small presentation in our small hike group. It's an Indian platform to promote Indian products again. So, what are the learnings from the present crisis? The most important learning is nothing is permanent, be it your jobs, be it your status, lifestyle, health, or even life. So, second most important thing is life is uncertain. Things can go off track. Holiday plans can be cancelled. One can fall short of EMI payments. Business can be affected. We the third most important thing is we found ourselves selves exposed to huge risk. The fourth most important thing is life is not bed of roses. So let's come to this. I don't have enough money surplus. Has anyone of you been facing these issues? If the answer is yes, the next question we need to ask ourselves is why did one have to face this issue? So the other question is what if one gets COVID 19 or coronavirus induced infection today? Apart from the health issues, what are the financial issues which can happen? What about the medical bills? What about the liquidity required to pay the bills? Any other health illnesses that may arise in this period which needs hospitalization? From where do we get the money? Are we ready with that money? Do we have that money, or do we have the risk cover to take care of the situation which may arise during this pandemic? The second most deadliest thing is what if I die of COVID 19 or any other cause right now in this pandemic? Have we prepared our family for such uncertainty? These are the questions we need to ask ourselves. Who is going to take care of financial needs of the family in case of untimely death of the earning family member? The third important thing is emotional and physical loss of family members gap remains unfilled. But what about the financial loss in case of the earning family member is no longer there? Have we prepared our family for it? So, what is the financial loss in case of death of a earning family member? Let's consider an example of Mr. Bhatwadekar. He is 35 years, has an annual gross income of 12 lakhs per annum. He plans to retire at 60 years of age. He is married and has two kids. Now, in 2020, that is the present year, he gets COVID 19 and he passes away. So, what's the financial loss to the family? Had he been alive for the whole of the his income age ranging from 35 to 60 years of age. So the financial loss is 25 lakhs into 25 years of his service. That is around 300 lakhs or 3 crores over the next 25 years the family would be getting. This is excluding his promotion. This is excluding his bonus. This is excluding his other additional source of income which he could have got. Was he alive? So, who takes care of the family in case of this financial loss? Has Mr. Bhatwadekar prepared his family for that? In majority of the cases, we have not prepared our family. So, that another important thing which can arrive in this COVID crisis is the jobs can be laid off. If the jobs are laid off, how do we pay the EMI? What about the monthly expenses? How do we pay the credit card bills? Kid education fees is also there. Utility bill payments have to be paid. So, how should one manage all the above when regular income suddenly stops? We prepared a strategy well before this thing occurred? If we have not prepared the strategy, this is definitely going to be a thought provoking thing to think about in this pandemic. So, there is one more problem which is happening. Inflation and recession are hitting hard on us. Let's consider an example. If we are saving alone is not sufficient. If we save alone and if we keep it in cash, 100 rupees saved today, if you hold it in cash, the value of 100 rupees will still be 100 rupees. But what is happening? The inflation and recession. If you have a look, the cost of commodity which is 100 rupees today, let's say a kg of rice is 100 rupees today. After a year, it will be 109 rupees. This is the inflation. Inflation is 9% approximately 8 to 9%. It varies from the commodity which we speak. So if you are holding it in just cash, The value of 100 will be 100. But what has happened? This person is falling short of 9 rupees because of the inflation. If the same money is kept in fixed deposit, it will definitely earn post tax return of 5 rupees for every 100 rupees. But even then, this person is falling short of 4 rupees. Now, gold. We Indians love gold too much. So, have we kept the same amount 100 rupees in gold investment? We do not know the value of the gold after 1 year. It is again market linked. It is again tracking the gold prices, demand, supply thing. But it is again leaving it to the future to decide what will be the value. And if it is less, if the returns are negative in gold, be ready to be hit hard against by this inflation and recession again. So, things which we need to tackle and what the present situation has made us realize are: risk has to be managed, and risk consists of disease, disability, and death. Three D's have to be managed. The second most important thing is uncertainty has to be managed. Uncertainty of job loss, unseen for emergencies like this 2020 year. None of us would have imagined this would have ever happened in our lifetime, that the jobs would be laid off, this emergency would be coming in, the people would be forced to stay indoors. All this has happened, and these are uncertain things. The third most important thing which the present situation is teaching us is inflation. All these things have been there even before this COVID crisis happened. It is nothing new. But every bad thing definitely teaches us a lesson. And this is the lesson: inflation. Savings alone are not sufficient. One needs to invest well to generate returns over and above inflation. So let's come to risk management. What is risk management? Risk is managing the risk of disease, disability, and death. Cover up basics even before you consider investing. Let's take an example. Had Sachin Tendulkar not worn helmets, pads, gloves, and guards before he started in innings, he would not have been at this stage of this career. So, risk management is important. Cover the risk. So, another important thing is do not try to save money in the most important part, that is risk management. I'm sure every one of you who would be having a car would definitely have a car insurance. And when you have a car insurance, the question you need to ask is, does the premium of the car insurance ever come back to you? So when the car insurance premium doesn't come back to you, why do you expect the return of premium to come back to you if it is health and life? That should also not come back to you. So if you are expecting that to come back to you, that means you are valuing the car more than your life. So disease risk management, let's come to it. Anyone and everyone can fall sick a number of times, starting from birth to death. It just goes to say, none of us are immune from this disease. We all are exposed in various degrees to this risk of disease, right from birth up to the death. And many diseases may need hospitalization, which may need medical and surgical intervention. And every such event which occurs is associated with financial burden apart from the physical and mental burden of the disease. So we are concerned more with this financial burden. So if you are not prepared for this financial burden, it will hammer your personal finances day in and day out, because this disease is not going to hit you once. It may hit you twice, thrice, 4 times, 5 times. Depends on our probability of getting the disease, and the probability is quite high considering the life expectancy to be now up to 80 years of age. So one cannot escape disease, and once one gets disease, one cannot escape hospitalization in some instances. So we need to have a strategy in place to manage this disease risk management. So let's come to this. No person is immune from disease requiring hospitalization. It's important to cover this risk while planning for family. How do you manage this financial risk associated with disease? The only answer is comprehensive health insurance policy. The moment one has kid, enroll that kid in health insurance policy which covers everything. That is known as comprehensive health insurance policy. It's a low premium product and it covers other disease, almost many diseases with some exclusion which you need to read before you buy the health insurance. There is a video in this same channel about how to buy the best health insurance. You are requested to go through it. So management of financial risk associated with death. The simple solution is term insurance plan. Now the question is, what is term insurance plan? It's a insurance which pays large amount to the nominee on death of the policy holder. It aims to make up for the financial loss of the deceased earning family member. So we took the example of Mr. Durendra Bhatwadekar, who was earning 12 lakhs per year, and his age 35 years, and he passes away today. He had a loss of 3 crores to his family if in case he died today. So that's the loss which this term insurance makes up. It's a low premium. The premium is very low, but the coverage is high. And the premium doesn't return back. No worries, let the premium don't return back. But the premium you are paying is very less for the coverage which you are getting it. There is a different video in this channel on how to, what are the two insurances which you only need, ever need. So do not mix insurance with investment. So dealing with uncertainty. Uncertainty can be sudden hospitalization, job loss, inability to pay EMI loan for many reasons which can happen in life. And important appliances of house can get broken. There can be breakdown which you need to replace it. So these are the uncertain things which we need to tackle financially. So how do we deal with this uncertainty? So to deal with this uncertainty, emergency fund or contingency fund is what is required. So what is this emergency fund or contingency fund? Simple. First, calculate the following things. You calculate your you calculate your 6 to 9 months expense. Fine. If you have any EMI, calculate at 6 months EMI. To this you add 50% of your health insurance coverage, and you get a X amount now. When you get this X amount now, slowly build up this emergency corpus over a period of few months and keep it aside. Label it. Do not touch it. Use it only for the intended emergency which we have already discussed. And every time you use it, make it a point to replace it back. It has to be replaced. And the other added strategy is keep increasing this amount by 5 to 7% every year. This is to take care of the inflation which happens. So keep on increasing it. Do not just restrict to 6 to 9 months of expenses. You have to keep on increasing it 5 to 7%. So what is this emergency fund? Where do you store it? Is it a product, or is it some product offered by the banks or by financial advisor? Where do you keep this emergency fund? Let's look into it. The most important aspect is keep it in cash. At least 1 month of your expenses should be in cash. It is immediately liquid. It's immediately available for consumption, and use it for only emergency needs. Second place is liquid mutual fund. The third place is arbitrage mutual fund. Fourth is your saving bank account. Fifth is your fixed deposits. You can liquidate fixed deposits online anytime, anywhere. And remember, wherever you store this emergency corpus after you have calculated it, you should never compromise on your liquidity. Do not concentrate on generating returns. Liquidity is very important. That's why it is known as emergency fund or Sanjeevani fund, which saves us when there is bad time. The third most important thing which we need to tackle is, how do you beat the inflation? Just investing in fixed deposits, mixed insurance products, one will generate returns which are lower than inflation and will have difficulty in future. So what's the solution? The solution is invest in an asset class which is known to beat the inflation. So which is this asset class which beats the inflation? Invest in equities which is known to beat inflation. So how does investing in equity generate returns and over and above inflation? Let's have a look. All of you are familiar with Good Day Britannia biscuit. It was a biscuit, an awesome biscuit in our childhood. It was launched in 1986. Do you remember this pack? Definitely. Many of us would remember it and would be still seeing it, and even our kids would still be eating it. So let's come to this. When it was first introduced in 1986, price of one standard pack was 4 rupees at that time. Now price in 2019, is 25 rupees for the same pack. So what does it mean? It means the average price has been rising on an average of 5.71% per year, right? That is the inflation. Why did these prices increase? The price increased because of the labor increase in labor cost, increased raw material cost, increased distribution cost. So what did Britannia company just do? Britannia company just transferred the inflation. That is the increase in prices in commodities to the end users. That's why the price of the biscuit has come up. So what does it mean? It just means Britannia profited back in 1986 too, and it is even profiting today in 2019 and in 2022. So what did it do? It just passed on the inflation to the end user. So in both the scenarios, it profited over and above the inflation. So the conclusion is investing in a profitable companies. One part takes the share of the profit, which is over and above the inflation rate. So equities are a must to have in a portfolio for you to be able to beat the inflation. So the take home message, friends, here is cover your basics. The basics are have a insurance for disease, disability, and death. Three D's have to be covered. Second thing is have emergency corpus or contingency fund, which is it's also called for unexpected events in life. Third thing is consider investments which beat inflation. Tackle these three things. These are the real life examples of what this present crisis is also teaching us. Thank you.